From Kansas State University, this is Agriculture Today. Eric Atkinson with you. As we get into the cattle markets, first of all today, K-State's Glynn Tonsor will talk about last week's market reaction to the latest USDA cattle on feed report, and he'll offer his thoughts on the leading cattle market factors here in 2018. Then K-State's Brian Briggeman will talk about a new K-State study of what allows agricultural cooperatives to attain what's called a sustainable growth rate, and how cooperative boards and managers can use that information to analyze their cooperative's economic status and plan for growth. Further ahead, K-State's Charlie Lee talks about ways to improve backyard bird feeding practices here in the winter. All this and more next on Agriculture Today.
Did you know every Kansas farmer feeds 128 plus people?
Kansas farmers are hard workers, dependable, authentic, and sensitive.
Not only do farmers put food on your table, but they put clothes on your back and fuel in your car.
For more information about Kansas farmers, visit K-State Research and Extension online or stop by your local extension office. This message has been brought to you by the K-State Animal Sciences Leadership Academy participants.
Welcome to Agriculture Today, and incidentally, Happy New Year to you. As we embark on this calendar year 2018, we take up the cattle markets, first of all, with Glynn Tonsor alongside, livestock economist, K-State Research and Extension. Well, Glynn, getting into this new year, we're coming off of a week which typically is not in the routine because of the holidays, but you'd have to say there was something of a positive tone coming out of this past trading week.
Yes, on balance, and that is, as you say, a tone not really documented by a high volume of trade, whether it's cash market or on the board, but nonetheless, I think sentiment is fairly high. We'll break down the cattle on feed report in a moment, and there are some bearish components of that, but on balance, I would say we ended 2017 on a upbeat note, which is making a lot of folks optimistic for what 2018 might hold. But let's break that down. Looking at the board, the February nearby live contract was about 121.5, up $3 for the week. Most of that increase is actually on Tuesday, first day after Christmas. The January nearby feeder cattle contract was 146, up a full $5 for the week, and likewise that increase was Tuesday and Wednesday following Christmas. And I note that of when that was is because the trade was thin during the week, as we'd expect. Not everybody came back to trade. Lots of folks take the holiday off in the trading arena. But something pulled that market up on Tuesday, Wednesday, and it could be the marketing skew of the cattle on feed report I'm going to mention in a minute, but it could also be the fact that cutout was up as well, and maybe that's indirectly confirming that holiday trade actually was good, that maybe actually pushed beef through the holiday season longer than we anticipated. So if, in fact, that holds, that's a positive thing going into 2018. On the cash market, fed cattle is flat, basically 120 for the week. I noted here the 5-market average quote was only 200 head on Friday, so it's thin. I'm not going to overreact to it. I will note that it's up over $2 compared to the same time the year before, and yet we have a lot more cattle going through the system. Similarly, feeder cattle, Dodge City, only 500 head and some odd number were traded. So again, don't overreact to these. But the market there was up $10 to $15 compared to same week of 2016. I'm highlighting that because we definitely moved more cattle through the system, and that only happens with higher prices if we had a strong demand setting. I've said that for probably 6 months straight. I'm going to keep harping on that because that's key going into 2018. And then finally, looking at this past week, cutout was actually up as well. Choice cutout was right at 203. Up $3 from the last quote, which was actually December 22nd, the week before Christmas, or days before Christmas. Select cutout was 193 on December 20th, as up about $5. So I'm hopeful that those cutout numbers are basically confirmation that the holiday season was as good as we were hoping it was, and maybe the actual traders confirm that. Again, we'll know that as we get back to, let's call it real trade here the first 10 days of January to see where the cutout values go.
But at least there's a foundation of support for these markets as we get into the new year. And the remarkable thing remains that we are moving cattle at decent prices in the face of hefty supplies, which were reaffirmed by that aforementioned cattle on feed report prior to the holidays. And to recap that, it would seem to be bearish in nature, but then again, the markets didn't respond totally in that direction.
Yeah, I think the question here is, what did the trade actually expect relative to the report and did they have different anticipations than the pre-report estimates? So I don't want to get too geeky here, but there's a lot of debate about that in this particular report. Probably the most talked about statistic was the November placements. It was up 14% compared to same time year before. Here in Kansas, we were up 14%. The Texas, Iowa, and Minnesota numbers were up more than 14%. I highlight that because our friends to the north, there's lots of discussion about not wanting to get rid of cheap corn. I think this is consistent with let's keep our corn and walk it off the farm if you like. Mm-hmm. I highlight that for watching roughly the April time period. The 5 market average price is going to be driven even more by Iowa, Minnesota activity than in the past. We need to monitor that. But on balance, that plus 14% placements in November for the country was well above what the pre-report quoted estimates were that averaged 5% and ranged only up to 9.3%. So not only was it higher than the average, it was actual placements came in well above the range of what the regularly surveyed experts were suggesting. That would be the bearish part of the report on balance, because that would say we put a lot of cattle in November. Quote unquote, we're going to have a swell coming out, 5, 6, 7 months later, and you'd anticipate live cattle contracts, particularly those deferred ones, to have been beat up following that. That's not what occurred, and I think maybe a lot of the actual traders, quote unquote, saw more cattle in the countryside than it showed up in the pre-report estimates, and were anticipating a higher placement number, and therefore the report wasn't out of whack with what they themselves anticipated. This is far from scientific, but I increasingly, kind of look at what email and Twitter traffic and so forth I get, and it's hard to quantify that, of course. But the sentiment there in the week or two leading up to this report, and certainly the 3 or 4 days after this report, when we're all at home over the holidays breaking stuff down more than normal, was that why should we be surprised? We all saw more cattle around the countryside. If anything, the debate was these pre-report estimates were out of line, and that the USDA high placement number was quote-unquote consistent with what folks running around in their F-150s were seeing. So that's a rationale, if you like, on why maybe the market actually wasn't as surprised as we would anticipate. To break the rest of it down, November marketings, 3% up year over year. That's basically flat across the states, 3% here in Kansas as well, right on par with what we expected, so no real news there. But I will pause here saying we do have the largest marketings for the month of November since this series started in 1996. Part of that's a bigger industry, but I'm going to highlight we continue to successfully market these cattle at prices, as you noted earlier, higher than anticipated. That's a very good confirmation of strong demand. And again, maybe a part of this report that's not as bearish as some would anticipate. And then the balance of that would be December 1st inventories up 8% for the year. We'll note here in Kansas, we're only up 4%. Other states, namely Iowa, up 17%, are pulling that number up. So Kansas yards aren't quite as, quote-unquote, full, relatively speaking, compared to the year before as our other states.
The critical question, and now getting into your expectations for 2018, Glynn, is can feedlots remain current given this hefty supply, but yet prices moving cattle in a sufficient manner? Demand is, of course, at the center of all of this.
Yeah, so demand is center of that because for much of 2017, retail demand, whether it was domestic or export-oriented, was strong enough that we, quote-unquote, pulled those cattle forward, right? So feedlots had an incentive to sell them. That supported our feeder cattle market, as we've seen, and we could belabor that more if you want. I'm optimistic, at least for the first half of 2018, that demand aspect of that will continue. What I will put a little bit of water on that idea for a moment, though, is we only have to look back to 2015 when our friends to the north, and I just keep picking on Iowa, Minnesota for a moment, but more the farmer feeder who walks the corn off the farm, we did have a hiccup of extra heavy cattle. So when you're asking me about currency, I'll remind us of that. We definitely have more of a surge in placements in the Iowa, Minnesota area, and we need to monitor exactly what those weights will be. Again, I'm just going to say April, May arena next year. And at the moment, it looks like there's decent incentives to, quote-unquote, produce heavy cattle again. Mm-hmm. So that could change. A big difference compared to 2015 would be in 2015, the industry was, quote-unquote, still short on cattle. We were coming after the really high returns in 2014. We pulled the trigger on expansion. And the reason I highlight that is packers and process weren't flush with cattle and therefore weren't flush with meat. The reason that's important, I don't think they were in position to put a heavyweight discount in place because they couldn't be, quote-unquote, picky about their cattle. They needed everything that walked to be processed to a certain extent here. Now we have more animals in the system. It would not surprise me if, quote-unquote, heavyweight discounts reflect this concern, and maybe we penalize heavier cattle more aggressively in 2018 than we did 2015, in which case that would send the market signal to not produce 1,600-pound animals. It might help us stay a little more current. So that's a long answer to your question. I'm optimistic on the demand front remaining sound, but I am well aware of that not too long ago history problem that, quote unquote, incentives in the short term created big animals, which created a bit of a hiccup in the fed cattle market. I hope we don't repeat that in 2018. And if we avoid it, I think it's going to be the heavyweight discounts will be different in 2018 than they were in 2017.
And it's important to couple continued brisk beef exports along with that.
Yeah, no, that's essential. And unfortunately, politics and exchange rates and trade negotiation deals are something no individual producer can influence. But frankly, they're probably influenced more by that in 2017 than in the past. And I think that'll continue in 2018 because we know with pretty much certainty we're going to have more meat production here in the U.S., which is going to put per capita availability at a very high level compared to the past. I don't want to call it a tsunami of meat. Some people are overreacting that way. We've consumed these levels on a per-person basis before. But if we lose any major export markets, then we're going to have to consume even more here at home. And that's only done at lower prices. So those export markets are essential.
And you touched upon this briefly, though, but there doesn't seem to be any suggestion whatsoever we'll see any kind of major herd expansion in the midst of all of this.
I don't think so, but I do have my list of things to watch is, we're sitting here, Happy New Year to everybody, following up on what I think was a Christmas gift in 2017 is many cow-calf producers who didn't hedge and just took the price available in October, November when they sold their fall wean calf had a much better 2017 than anticipated. I highlight that because those that were maybe shrinking their herd might have stopped shrinking, and maybe those that were kind of neutral on the future have become a little more optimistic and might at the margin be marginally increasing the herd. I don't think we're going to have national expansion, but I will tell you I'm sitting here watching and thinking about it, or I wasn't even thinking about it. I would just give you a wholesale no, we're done with that 6 months ago. Mm-hmm. So this is kind of the flip side of a good demand story is we pulled those feeder cattle prices up in the end of 2017, and it would surprise me if at least some segment of the industry thinks that's going to persist and now wants a larger female breeding herd going forward. So the January cattle inventory report always gets watched. The July cattle inventory report will get even more attention in 2018 because of this.
Glynn, thanks. Looking forward to working with you again in this new year.
Thank you, Eric.
He's a livestock economist, K-State Research and Extension, Glynn Tonsor, with this week's Cattle Market Insight on Agriculture Today. Agricultural producers, landowners, and creditors, you have a partner in your legal and financial needs. Kansas Agricultural Mediation Services offers reliable, trusted information and guidance. Whether you need advice for ag credit concerns or are transitioning your operation to the next owner, Kansas Agricultural Mediation Services can assist you in making sound decisions for your business. To learn more, call 800-321-3276 or visit us online. Welcome back. You're tuned in to Agriculture Today. On this segment, we want to discuss the obvious growth that we've seen in our agricultural cooperatives in Kansas over the last many years, and a new write-up based on research out of K-State on sustainable growth rates for cooperatives. We'll explain what that concept is all about right here as we're visiting with Brian Briggeman once again. Brian, you'll recall, is the director of the Arthur Capper Cooperative Center in K-State's Department of Agricultural Economics. Brian, this growth phenomenon we've seen in cooperatives in Kansas, it's been rather substantial, hasn't it?
You're right, Eric. If we look over time how co-ops have changed, it's been very significant. Many things have influenced it, from producer consolidation, right? Farmers are getting larger. They have different needs. Technology has come at us. It's changed the way we farm today, and new global markets have opened up. All of that has really changed our agricultural co-ops. So if we look back over time, just to put this in context about the growth and how it's changed, back in 1950 in Kansas, we had 350 farmer cooperatives. Today, we have 71. So it's just been a tremendous amount of consolidation. And a lot of that has also led to some growth in order, like I said before, to meet the needs of farmers, their owners, right, of the cooperatives, what they need today in order to be efficient and drive their farms, to be successful.
So fewer cooperatives, but larger in scope. This sustainable growth rate as a measurement of, in essence, the economic health of an agricultural cooperative. What is this, basically?
So this is something that I've worked with other agribusinesses, even typically larger, multinational, maybe even publicly traded, and other businesses work within this framework or idea of a sustainable growth rate. So what it is, as I've seen this consolidation and change that has happened and have been in boardrooms and had many discussions with cooperative directors, managers, CEOs, employees, it's a nice way to kind of frame up a discussion of how we should grow strategically, right, as a framework. Not that it provides the answers, but it gives us a way to kind of frame up strategic growth. So many other businesses use it. So this was a line of research that I'm working with a graduate student on to say, hey, what can we gain from this? What knowledge can we gain from this and apply it to Kansas cooperatives? And the thing that's nice is it is that framework, right? It sets it up in a way that we all can have a discussion and better understand growth, but do it in a sustainable way so that our cooperatives can be around for many more years to come.
So it serves or can serve as something of a roadmap for those board members, for the management of those co-ops to plan for the future and get a grip on where they are right now. The components of this sustainable growth rate, it's a fairly straightforward calculation, you say, right?
It is. And in the fact sheet, which you can find on our website at accc.ksu.edu, it gives the detail and how we actually calculate it and how we apply it to the data that we have. But for purposes here, just to kind of set it up in the framework, it really boils down to 4 levers that co-op directors and managers can pull to help drive sustainable growth. The first is looking at earnings retention. So earnings retention is looking at how much of those earnings that we have at the end do we retain within the cooperative in order to help finance various infrastructure or things that drive growth that require money. So how much are we retaining within? So that's the first one. Second is to look at leverage. So leverage here, we're talking about debt capital. So when we go out to borrow money, right, in order to fund growth, that's another way, another lever that we can pull to do that. Third is profit margin, right? So being a profitable company, which all helps to drive that bottom line, right, that we can drive our growth rate. And the fourth and final one is operating efficiency. So utilizing that infrastructure, those assets, those fixed assets that we have available to us at the co-op to drive it as efficiently as possible. So those 4, earnings retention, leverage, profit margin, and operating efficiency, really encapsulate and calculate, really, the sustainable growth rate for cooperatives.
And cooperatives have the numerical forms of each of those 4 on hand, and they can basically do the simple math, which is outlined in this write-up. We won't go through all of those mechanics here. But of those 4 elements, which one is really the key as far as that sustainable growth?
Right. So in the fact sheet, we go into some calculations and we do break it down, the different levers. I think first thing to think about is, today the growth that we're experiencing, what is the sustainable growth rate? Well, by our calculations for Kansas cooperatives, now this is on average. It's going to vary for each individual co-op, but on average, it's around 10%. So looking at that, that sales growth that we would experience. So if we look at that 10% and how you get there, right, the 4 levers, earnings retention, leverage, profit margin, and operating efficiency, our research clearly shows the most important lever to drive sustainable growth is profit margin. It's the one that if you do not have it, you do not have growth. The clearest example that we talk about in the fact sheet is the farmland bankruptcy that occurred in 2002, 2003. Very difficult time for cooperatives. And in fact, on average, we saw profit margins dip into negative territory. And the way that our calculation works, sustainable growth rates went negative, and that's never a good thing. So as I work with boards and talk with management teams, the most important thing when it comes to sustainable growth is you have to have positive margins. We must be a profitable business because without that, nothing else happens.
Which makes perfectly good sense, as a matter of fact, when it comes to growth. When we look at growth and the consequences of it, it's presumed to be a positive thing. There can be too much of a good thing by the same token, so the numbers become interesting here, Brian.
Yeah, there has been a lot of expansion and a lot of growth, not just here in Kansas, but across the United States. I've been to many different conferences, talked with many different farmer cooperative leaders, and there has been substantial growth. But the question is it sustainable? Mm-hmm. As that kind of happens. So part of the other thing that's nice about the sustainable growth rate and for directors and managers is to say, okay, if we have rapid growth, what can we do? I think before I get into breaking that down about what the model tells us about what you can do, it's more important to say if you're going to have a growth discussion, strategic growth, whatever that may be, first and foremost, does this add value to the membership? How does this make farmers, our owners, better? And furthermore, growth for growth's sake doesn't work, right? There has to be some end goal, some strategic goal in place that ultimately adds value back to the membership. So if we put that plan into place and we do experience very rapid sales growth that far exceeds what is sustainable, what do? Right? We have a plan in place. We need to see it through. What can a co-op's board and managers do? Well, in our research that we've talked about, and we break it down in the fact sheet, and we've also done some additional things to kind of drive this point home, is when that challenge arises, actual growth exceeds your sustainable growth, a board really has two key things that they should focus on. And it goes right back to those 4 levers. The first is leverage. Acquiring additional debt capital to get you through that very rapid growth time so that you can meet your goals and objectives is one way that the sustainable growth rate model tells us that you can work through that challenge. The other is look at operating efficiency, right? So if our actual sales growth is far exceeding our sustainable growth rate, we need to really focus on our assets, our fixed assets. Are we using them as efficiently as possible? Looking at volume and throughput and making sure that the assets available to us are being run and managed very, very well. The other two, the earnings retention and profitability margin, when we have that challenge in place, really are not as important. So in order to meet that rapid growth, we need to consider that leverage and operating efficiency. But first and foremost, you have to have a clear strategic goal in mind. And how is it going to benefit the farmer?
And that's where applying this model comes in useful for those boards, for those co-op managers. Full analysis of where they stand, where they're going, what they need to do to maintain that growth, sustain it, as the name would imply.
Right.
There's a write-up on this on your website. It goes through the entire definition of the sustainable growth rate and some examples of how it works and so forth. And you would encourage all of those folks involved in cooperative management to have a look at this and take it up as a management tool.
Right. Yeah, just the way I view it is not that it's going to provide the answer. It's not the silver bullet to figuring out sustainable growth. Rather, it's a great way to have a boardroom discussion, to have a senior management team discussion. And in fact, download the fact sheet at accc.ksu.edu. It's just part of our fact sheet series and, part of our purpose at the Capper Center to provide relevant education and research to the cooperative community.
If you have any level of involvement in local cooperative leadership, by all means, have a look at this information. It's a really good read and good guidance on how to use, as the title would imply, sustainable growth rates for cooperatives. Brian, this is great work. Thank you for letting us know about it right here.
Thanks a lot, Eric.
He's the director of the Arthur Capper Cooperative Center here at Kansas State University. Brian Briggeman, you're listening to Agriculture Today.
Hamburgers, roast, ribs, steak, or whatever you prefer. Beef, it's what's for dinner. Kansas cattle farmers produce 7.5 million head of cattle per year. It takes about 7 tablespoons of peanut butter to get the same amount of protein in 1 serving of lean beef. Support your local Kansas farmers and ranchers. Eat beef. This message was brought to you by the K-State Animal Sciences Leadership Academy participants.
Agriculture Today continues now here on the K-State Radio Network. Once more, glad to have you aboard. Eric Atkinson here. Now for today's agricultural news headlines, these courtesy in part of DTN. Well, what kind of farm income situation will we see here in 2018? A heady question indeed. Here are the thoughts of one USDA economist, as reported by the USDA's Gary Crawford.
The Agriculture Department has not yet made a forecast for 2018 farm income, but there are some hints. 2017, generally a year of flat to falling commodity prices. USDA's chief economist, Rob Johansson, expects for 2018
another year of the same.
And besides sales of products, though, farmers' income can include direct safety net programs from the government. In 2017, they were down nearly 14% from 2016, and Johansson says for 18,
we would expect government payments, by and large, to be smaller than they were in 2017.
For example, in the ARC, the Ag Risk Coverage Program,
the payments under that program are going to become smaller as each year passes. With the Olympic average, we're going to be dropping out those record high years we saw in 2012, 2013. As those fall out of the calculation, payments to be received by producers that are enrolled in that program are also going to come down.
Meanwhile, farm production costs have been rising after 2 years of decline. So now these factors may hint at lower farm income in 2018, but there's still lots of uncertainty. USDA will make its first official farm income forecast in early February. Gary Crawford for the U.S. Department of Agriculture, Washington.
Grain sorghum may see another renewable fuel standard boost from a newly proposed pathway for sorghum oil extracted from ethanol plants, according to a new rule proposed by the Environmental Protection Agency. Back on December the 19th, EPA Administrator Scott Pruitt signed a proposed rule to allow sorghum oil to qualify as a biofuel feedstock for advanced biofuels and biomass-based diesel. The EPA proposal came about as a result of a petition filed by the national sorghum producers. In the proposal, the agency estimates about 30% of grain sorghum grown, or about 120 million bushels per year, is used to produce ethanol. Distillers' sorghum oil is still a relatively niche product, and the producer's petition anticipates a potential of 12 million to 21 million ethanol equivalent gallons of fuel to be produced from the oil per year, according to the EPA. The agency would allow for a number of oil recovery methods at ethanol plants, including recovery of sorghum oil before fermentation from the slurry or from liquefaction tanks, and sorghum oil recovery after fermentation from the thin stillage and/or distillers' dried grains with solubles, or DDGs. The EPA is anticipating sorghum oil producers will attempt to sell the reduced oil distillers to poultry, swine, and dairy operations, as these markets allow them to obtain a higher value for their product. Dairy cattle producers may be willing to pay a premium price for reduced oil DDGs, according to the EPA, as lower oil distillers' grains improve milk production. The sales of reduced oil DDGs to the beef cattle market are likely less enthusing, says the agency. It says the product required the fat content of the DDGs could be augmented through the addition of distillers' sorghum oil, thereby reducing the volumes of biofuel produced from distillers' sorghum oil. According to the petition, grain sorghum oil should yield about 0.67 pounds per bushel of grain sorghum. EPA models point to an average DDG's yield of 17 pounds per bushel of grain sorghum. The use of grain sorghum in biofuels production remaining relatively flat. Currently, 13 ethanol plants list corn and sorghum as feedstocks. Most cases, sorghum used as the secondary feedstock by those plants. Sorghum as an ethanol feedstock used primarily at plants here in Kansas, as well as Missouri, Nebraska, South Dakota, California, and Texas. And the recent rise in anhydrous prices has crop farmers' attention right now. The retail price of anhydrous, $461 per ton the third week of December 17, up 12% from the third week of November 17, according to retailers surveyed by DTN. The good news, though, there was a lot of nitrogen applied this past fall. Suppliers in the spring ought to be fairly solid, say industry experts. In addition, farmers could possibly shift to other forms of nitrogen to give some of the prepay spreads that appear to be closer than usual. Now it's on to this week's edition of Milk Lines with K-State dairy specialist Mike Brouk. Mike?
Today I want to talk with our Kansas dairy farmers concerning Christmas corn silage. Maybe you've never heard that term, but this time of year we generally see some changes in that pile of corn silage that we put up either back in August or September. So what am I talking about? Well, one of the interesting things with corn silage is over time the availability of the starch actually increases. When we first put that pile up, the availability of the starch was probably only about 62-63%. As the fermentation took place and we had organic acids form, those organic acids go to work on the starch matrix. And as a result of that, the starch becomes more available to our dairy cows. Usually takes about 18 to 20 weeks for this to happen. So that silage that we put up in either August or September now is past that stage, and that starch has become much more available. Well, how much more available? Actually, it's generally about a 24% increase in starch availability over those 18 or 20 weeks. So, how do the cows deal with this? One of the things we sometimes notice around this time of year is milk production has kind of steadily been building over the last few weeks, and all of a sudden we start to see a drop in fat tests. So maybe you were getting pretty close to a 4.0 fat test, and now as you look at your bulk tank results, maybe it's a 3.8 or a 3.7 or maybe even below that. So what is the cause of this? Well, as that starch became more available, it changed the fermentation inside the rumen of your cows. And as a result of that, we had some changes in her metabolic functions and a reduction in fat test as well. So what are some other things you might be noticing in your herd if this is going on? Well, you may see some inconsistency in the stools of the cows. In other words, some loose stools, maybe some indication that you might be seeing some acidosis. You may see some animals that are on and off feed, eat pretty well today, but tomorrow they don't eat quite as much. So what should you do about this? Is it correctable? Yes, it is. So you and your nutrition professional on your farm need to have a discussion. There's several different things that can be done. May need to increase the amount of fiber in the diet, may need to decrease the amount of starch in the diet, may need to decrease the amount of starch in the diet and increase maybe some fibrous byproduct feeds that you might be feeding. Or you may just simply decrease the amount of corn silage in the diet and increase the amount of hay or haylage that you might be feeding. So, lots of choices out there, lots of different ways that we solve this problem. It is a solvable problem, and it can help increase the fat production from your dairy cows, which will increase your check without decreasing the amount of milk that they're actually giving each day. This is Mike Brouk with K-State Research and Extension, encouraging our dairy farmers to evaluate their corn silage and changes in starch availability since they first started feeding the crop.
Thanks, Mike. And this is Agriculture Today.
While many people know hunger is an issue in developing countries, it is also a problem in our own backyards. In 2010, 1 in 7 Kansans struggled to put adequate food on the table. 2 K-State Research and Extension programs are tackling this problem. The Family Nutrition Program and Expanded Food and Nutrition Education Program reach thousands of Kansans in more than 70 counties. They learn how to eat healthy with a low budget. For more information about these programs, visit ksre.ksu.edu.
We're back now on this Agriculture Today. Our weekly wildlife feature comes your way now. Charlie Lee is a wildlife specialist with K-State Research and Extension. Feeding birds in the wintertime, a favorite pastime for many a homeowner out there, Charlie. However, some go about it in a less than ideal way here, and you wanted to talk about those bird feeding errors, and you say there are quite a handful of these.
Yes, it's easy to get started feeding birds, but it's also easy to make some very simple mistakes that keep birds from enjoying the feeders or utilizing the feeders, and other mistakes that keep the people that put the feeder up from enjoying viewing the birds. And I think one of the very common ones is that you place the feeders too far from cover or trees. Birds like chickadees and titmice and nuthatches prefer to perch on branches, look over for danger, and then very quickly dart in and get something to eat. Then feeders that are placed too far away from that security of the proper shrub and tree cover are just simply ignored. So you're not going to get birds to utilize the feeder if they're not placed close enough to food and cover. The other one is that you may place the feeders the improper distance away from the window. Most of the time, the feeder is placed too far away from the window, and you don't get a good viewing distance of the birds. I've found that when these feeders that are a considerable distance away from the home, particularly if the home has large windows, you're not able to see the birds, and the birds, when they are startled and fly away from the feeder, are more likely to crash into the window. And since they have a good speed build up before they crash into the window, you have lots of mortalities. So it's difficult to get people to think about putting the feeder up close to the window, but I think closer is better. You just have to deal with the debris up next to the house as opposed to a little further away. So try to find a location that meets your needs as well as the needs of the birds you're hoping to attract.
What about the feeder itself? There are numerous types out there on the market. Does that make a difference in one's feeding and then viewing success?
Sure. Birds have different diet preferences, and different species prefer different feeder styles. We have open feeders that have trays or perches. They attract a different variety of birds. But to maximize bird feeding, use different feeders. Don't settle on just a single feeder. Consider something like a mesh sock for goldfinches, nectar feeders for hummingbirds, suet feeders for woodpeckers, mealworm dishes for bluebirds, and even jelly feeders for orioles. All types of feeders will increase the diversity of birds that you get visiting your feeder locations.
And that means then you need to provide an equal variety of feed itself.
Yeah, if you're providing a diversity in food items, it's going to help you attract the species that you're trying to attract to a location. Many desirable birds can be attracted with a mix of food offerings. I like to keep my seed choices separate. There are many bird seeds that are sold as a mix, and I often find that some of those are wasted and not utilized very frequently by the primary birds you're hoping to attract. And using some of those feeders that have perhaps cracked corn or milo or wheat in them, oftentimes those appeal to very few species, and those birds then just toss that seed up onto the ground, which then causes a mess when it sprouts next spring, and also leads to rodents and other undesirable mammals coming up to feed on that waste grain.
So you may not want to feed on the cheap here with lower quality seed, in effect.
Well, I like to use higher quality seed and make sure that the seed is of good quality when you purchase it. There are some retailers that sell product that's less than excellent. Some of it may have been moldy or damp. I want to make sure that what you're putting out there is a good, healthy food ingredient.
And maintaining the feeders, that's important, you say?
Certainly important to maintain the feeders. Many people don't consider the other forms of wildlife that raid feeders before birds get a chance at a meal. Things like raccoons, squirrels, even rats and opossums are problems at feeders. Occasionally, by selecting the right type of feeder, you can minimize some of those problems from some of your unwanted visitors, or perhaps just enjoy all of the wildlife that come to utilize your bird feeder.
Not only do you want to protect the bird feeder from other critters getting into it, but every once in a while it needs to be cleaned itself, you say.
It's certainly a mistake to assume that wild birds aren't picky about clean feeders. I think a dirty feeder that's clogged or wet and has an ample amount of spoiled seed just as a disease conduit into backyard birds, and then that can quickly spread to the entire neighborhood. So make sure that you're cleaning your feeders at least twice a year. I usually just use a simple 10% of bleach and water solution to disinfect the feeders. Make sure that there's no moldy seed stuck in the cracks and crevices, and I think it will be a much better food source for the wild birds that are visiting.
One last point you wanted to pass along today, and that is storing one's bird seed or other feed resource, make sure that it stays in good condition before you take it outside?
Now, bird seed does have a fairly long shelf life, but if it's stored improperly, that's shortened dramatically. And by putting out feed that has been damp or has been invaded by insects or other pests like moths or small rodents, it's certainly not as valuable as a food resource as it is when it's put out in a nice, fresh manner.
So if one will take the time and make the effort to manage their feeding and their feeders appropriately, Charlie, they will see perhaps market improvement in the bird activity around their home.
Yes, I think you would soon realize how enjoyable this is, because it is certainly a practice that's enjoyed by very many people across the countryside.
Well, suggestions there for you on feeding birds and some things to do and some things to avoid as you provide that supplemental feed to birds in the winter. And Charlie, thank you for these tips right here. Wildlife Specialist, K-State Research and Extension, Charlie Lee. Before we go, remember you can subscribe to a podcast of each day's broadcast. Go to ksre.ksu.edu/news and click on the Agriculture Today link. The instructions for subscribing will be right there. ksre.ksu.edu/news. Thanks for tuning in today. Eric Atkinson here for Agriculture Today over the K-State Radio Network.